Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, Senior Currency Analyst at MUFG. It's Friday, 12th January 2024, and joining Lee to pose some questions on the financial market themes for the week ahead is Seiko Kataoka Fisher, Vice President from Japanese Customer Sales for EMEA in London. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Hi, Lee.
Hi, Seiko.
What's been driving the FX market at the new calendar year?
Hi, I think at the start of this year, markets are kind of pausing for breath after, obviously, we saw a big dovish repricing in rate markets at the end of last year as the market moved to price in earlier and deeper rate cuts from the Fed and other major central banks at the end of last year. And really at the start of this year, I guess the market's looking to see whether those expectations are likely to be met from the major central banks. So over the last week or two, we've had obviously important data releases at the start of this year from the US, where we had obviously stronger payroll data for December, stronger CPI report as well earlier this week. But that's been offset today by the softer PPI data, which has made market participants more confident that we'll see another softer PCE deflator report for December. And the core PCE deflator is what the Fed is most focused on when they're looking at setting policy. So it certainly looks like we're going to be seeing more evidence that the core PCE deflator has slowed at the end of last year and is now running an annualized rate of around 2%. So that should give the Fed more confidence that inflation is slowing back towards their target, and it is keeping alive expectations that the Fed is going to cut rates this year and could deliver the first rate cut as soon as at the March meeting. And that to us is still one of the key reasons why we've seen the dollar weaken quite sharply since late last year. Other than that, obviously here in Europe, the central bank officials from the ECB are still somewhat reluctant to talk about the possibility of rate cuts at this point in time. Unlike the Fed, they're very keen to stress that they're not yet discussing the possibility of rate cuts at the start of this year. So there is a bit of a divergence that's opened up there where the market's becoming more confident that will be the Fed that cuts rates ahead of the ECB, and that's putting some upward pressure on euro dollar, which is attempting to try and break back above the 110 level at the end of this week. I guess the big kind of divergence though in terms of rate pricing developments recently has been what's been happening in Japan, where we're actually seeing more of a dovish repricing taking place at the start of this year. Our own view that we thought that the BOJ could begin to hike rates in January and exit negative rates. That view is looking less and less likely now. So you look at recent comments from BOJ Governor Ueda have signaled that they're unlikely to have enough information since their December meeting and the January meeting to consider raising rates later this month. And obviously since then as well, we've had the earthquake as well in Japan, which just adds additional uncertainty to the economic outlook. And with the BOJ still very cautious, just makes them even less likely to pull the trigger and exit negative rates as soon as this month. So all in all, to us, it does suggest that it's looking more and more likely that the BOJ will delay rate hikes at least until the April meeting. So that delay is encouraging market participants to sell the yen again at the start of this year, and is leading to some renewed yen weakness in the FX market. And then finally, the other development which has attracted some attention at the end of this week is obviously the rise in geopolitical tensions again in the Middle East, where we've seen the US, UK, and other allies launch military strikes against the Houthi rebels in Yemen. To us, this marks another step in the conflict in the region, and will certainly increase concerns that the conflict there could broaden out and have a more disruptive impact for markets. So that's certainly something that we need to continue to watch. We did see the price of oil jump back up towards $80 per barrel today. So we're certainly watching oil and energy prices. If that was to intensify the spike there in prices, then that's something which could prove disruptive for markets going into next week.
What are you looking out for in the week ahead?
Yeah, next week is going to be interesting. I think at the start of the week, we'll be looking at the outcome from the elections tomorrow in Taiwan. I think those elections are likely to be important in terms of assessing geopolitical risks in Asia. Obviously, at the moment, it's looking likely that the incumbent government party will retain their position in power in Taiwan. And as we've seen in recent years, they have strengthened their relations with the US, while relations with China have deteriorated. So in recent years, that has contributed towards underperformance for Asian currencies as the markets move to price in the risk of higher tensions there between China, Taiwan, and the US in that region. So the election will obviously be important in determining whether that kind of negative dynamic remains in play. If there's going to be a surprise, then it would be obviously if the incumbent party was to lose its majority in Parliament, and if the opposition parties then were able to disrupt their ability to make policy going forward. I think that's something perhaps the Communist Party in China would welcome, and for markets that could be seen as potentially easing some of the tensions going forward between China and Taiwan, although obviously that would remain to be seen. But short term, at least, that could be something which could trigger a bit of a relief rally for Asian currencies at the start of next week if that was to materialize. We'll also be looking at the latest economic data as well from China at the start of next week, where we get the release of the Q4 GDP data and latest monthly activity data for December. Our expectation is that data should provide confirmation that China's economy lost some upward momentum at the end of last year after we saw a pickup in growth in Q3. It's still sending a cautionary signal to markets that China's economy is still struggling to grow at a stronger rate despite the policy stimulus that we've had really since the middle of last year. And to us, that general kind of cyclical weakness in China is still a key kind of headwind to Asian currency performance this year. And then finally, in terms of main data releases as well over here in Europe, we get the release of the latest inflation and labour market data from the UK. And I think that potentially could be market moving for the pound next week. As we saw back in December, both the CPI data and the wage data from the UK surprised to the downside quite significantly in terms of the CPI data. So it looks like inflation is going to significantly undershoot the Bank of England's forecasts for Q4. So unless there's really a kind of big upside surprise in terms of the CPI data next week, it does look like the Bank of England will have to make significant downward revisions to their inflation forecasts in the February quarterly inflation report. So to us, that's something which should encourage the Bank of England to become more confident that the inflation outlook in the UK is improving and move them in the direction of cutting rates. We still think that they will kind of lag behind the Fed and the ECB in terms of cutting rates this year. So short-term wise, that could still help the pound to kind of outperform on a relative basis. Certainly, I think as well, an additional factor which is getting more attention here in the UK at the start of this year is obviously we're in an important election year here in the UK. So we've had comments from Prime Minister Sunak suggesting that he is favouring holding an election in the second half of this year. So obviously ahead of that election, the government has a lot of work to do to try and boost its popularity in the polls, given it's lagging well behind Labour. And one thing that they could do in the upcoming budget, which they've announced will take place on the 6th of March, would be to utilise the additional headroom to provide more fiscal stimulus. Obviously, we've had quite a sharp move lower in the UK government's borrowing costs over recent months, and they could utilise that room to provide more stimulus ahead of the election to try and boost their popularity. That potentially could be certainly important for Bank of England decisions this year. Obviously, if the government loosens fiscal policy more notably in March, then that would certainly discourage the Bank of England from cutting rates more aggressively this year. So we think that as well could be kind of contributing potentially to some pound outperformance at the start of this year. Obviously, the risk would be that if that fiscal stimulus meant that kind of fiscal concerns in the UK resurfaced, that would then turn into more of a pound negative story. But at this point in time, that's not something that we see kind of materializing.
Great. Thank you, Lee.
Thank you.
Thank you for listening to this MUFG Global Markets podcast. Rate, review and subscribe, and contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.